Well, good afternoon. Good afternoon to all here, our live audience, and good afternoon to all that are joining us on the web. I'm Rob Rolacco. I'm the global head of ETFs here for Cboe Global Markets, and I'm delighted to be joined by two of our largest and most dear partners here at Cboe Canada, recognizing three new BMO ETFs in conjunction with ARK Invest, now being listed primarily here on Cboe Canada. I'm joined today by CEO Kathy Wood of ARK Invest, and Kevin Prinz, ETF distribution, head of distribution for ETFs at BMO. So both welcome, and thank you so much for joining us here in Toronto.
Thanks for having us.
Well, first, many of our viewers definitely want to know, how did this marriage come together between BMO and ARK here in Canada? The products, love to dive in and just understand more about the lineup here, the range that are now available to Canadian investors in Canadian dollars. So maybe Kathy, starting with you.
Sure. Well, we were looking for a partner in Canada, knowing that there was a lot of interest in what we were doing. And as we were looking around, BMO had really blazed a trail in the ETF world. Very innovative, very agile. And we thought, okay, maybe let's talk. And as we started talking, we began to understand that, hey, we might have something here. One of the interesting things about Canada is you here, the investors here, have adopted active equity ETFs much faster than in the United States. And so Canada was on our radar screen from the founding of ARK in 2014. And so we're just so happy that we have one of the most innovative companies involved in the ETF space here in Canada as our partner, and thrilled that Cboe is our partner, not only here, but in the US and in Europe. So really delighted to be sitting here with two partners.
Kevin, when we think about the products in the lineup here in Canada and the trusted nature of the BMO brand, now with these products in collaboration with ARK, what does that mean for Canadian investors in accessibility?
I actually think it makes it even more accessible. Like, as the innovation, certainly a lot of people wanted to simplify format doing it, right? And you got to think about, first of all, what Canadians starting with Canadian dollars. Yeah, that's the American money. You got to convert that currency. So what we like to do is we like to simplify investing. So number one, can we mitigate that currency conversion cost? Yes, we can do that. So we can do institutional trading here and get institutional currency, right? In addition, currency exchange, sorry. In addition to that, if you think about from a Canadian perspective, there's a lot of taxation aspects as well as potential for U.S. estate tax. How do we mitigate those aspects too? So we're going to simplify investing for Canadians.
You've done it. Kathy, maybe looking at something that's quite unique to ARK, the time horizon when you think about investing, and definitely many in the audience would love to understand your thoughts, as that is quite unique, and then maybe looking at your thoughts from a short term and a longer view at the moment.
Sure. This has been a very interesting market. Certainly the last 5 years, a lot of volatility. And I think what has happened over the last 5 years is with interest rates being hiked by 22-fold, not 22%, but 22-fold, from very, very low levels that have been in place for a very long period of time to 5.25% or 5.5% on the Fed funds rate, has been a shock to the system. And I think investors are still a little concerned about what the ultimate ramifications of these interest rates and the shock that started them will be longer term. So there has been a shortening of time horizons, and risk appetite has been very low. So what has happened, as interest rates have stabilized, so the Fed stopped raising rates, as they have stabilized, there has been a shift into equities, just a tiptoeing into equities, but it's been pretty careful and very specific. You've heard a lot about the concentration of the markets towards really 6 names in the US, the Magnificent Six. They kicked Tesla out from the Magnificent Seven when it started underperforming. And I was kind of happy about that, as a matter of fact. But so Mag 6, and so we're seeing the concentration, record-breaking concentration. Never seen anything like this. If it continues, what does that mean? It means more and more of the risk in the market is associated with that concentration. ARK has a different time horizon, 5-year investment time horizon, as opposed to what seems to be a 1-quarter time horizon. What are you doing for me today? Whether it's revenue growth, dividends, share repurchases. That is where the market is now. That's why we have the Mag 6. We have a 5-year investment time horizon. So what we're doing is we're saying, yes, AI is the biggest technology platform shift in history. It is going to be powerful, and it is in very early days, very, very early days. We are trying to pick the winners who are going to leverage upon the GPUs and the cloud infrastructure that has been evolving for the past few years. And those names are in unexpected places. I think many people in our flagship strategy, ARKK, are surprised to know that our healthcare weighting is as high as our technology weighting. Why is that? It is because of the convergence between artificial intelligence, sequencing technologies, so DNA, RNA, protein, methylation, epigenetics is complicated. Only AI can figure out how to figure out what in our genome, the 6 billion bits of code in our genome, has mutated in the last year only. And once we're able to isolate a mutation, again, not a human being, a machine, we can use something like gene editing to correct the mutation. This is going to cure disease. Think about that. Who with AI, when thinking about AI, is saying, yes, this is going to cure disease? They're not thinking about that. We're thinking about that. And in fact, in the top 10 of both the ARKK and ARKG is CRISPR Therapeutics. And CRISPR Therapeutics has used AI sequencing technologies and is a gene editing company. It is curing beta thalassemia and sickle cell disease. Not only did those diseases not have a cure, they didn't have anything to treat symptoms. Now, with 1 dose, they're cured. And this is after 4 years we've learned this. So you're not hearing those stories. Why aren't you hearing them? They're not in the indexes. They're not in the broad-based indexes. So our strategy is to be very active relative to the broad-based benchmark. So our overlap with the broad-based benchmarks is really only 5%. And that's a differentiated, diversified exposure to innovation. Innovation, not just AI, but robotics, energy storage, blockchain technology, and multi-omic sequencing. We're in the most exciting time in innovation history, and the ground is fertile. Our names are not in benchmarks. We consider that a value add to our clients and a nice complement to the broad-based strategies that are concentrating more and more.
Maybe building on, and as long as I've been known ARK and known the firm, the word innovation is synonymous. And looking at the innovation that you're looking for, that disruptive innovation versus that sustained innovation, how should we think about that? How do you and the team think about that?
Sure. So we can take the Mag 6. Now, NVIDIA is truly disruptive innovation, and we can get to what pulled away from that to move into these other expressions and winners in AI. But if you look at the others, you look at whether it's Meta, Amazon, Microsoft, they were born a long time ago in another age. In the case of many of them, it's the internet age. And they are going to harness AI and they will introduce new features and functionality that only AI will enable. But they're not AI first, right? They were born in another age, on another platform, and so they will enjoy the fruits, but they will not, longer term, be the primary beneficiaries. We think the true disruptors, which we believe are in our portfolios, the true disruptors are going to be, they were born AI first, and they're going to have more degrees of freedom. Just to give you an example, Apple is working with OpenAI and will work with Anthropic and other of the foundation models out there, the large language models, and they will introduce new features and functionality, but also think about their mission. It's all around privacy and security, and that makes people feel good. Okay, AI won't go rogue on me here with my Apple phone, and that is absolutely true. But there are other companies out there evolving that have AI first and are going to introduce features, functionality that AI absolutely will not, because it risks violating, their raison d'etre. They built their brand this way. So we would consider Apple sustained innovation, and we're looking for others in the mobile space that will be transformative. And they're probably brewing right now in the private space. There's so much capital in the private space. We can't wait for the IPO window to open up again. That's when we will be introducing companies that are probably going to blow our minds in terms of capability.
Kathy, maybe just building on that and specifically coming back to AI, how are you and the team positioning AI today inside of portfolios that you manage?
Right. So AI is going to permeate every sector, industry, and company. If we want to look at the companies that are going to win, they're going to have 4 characteristics. They are going to have deep domain expertise. So I'm going to go back to the multiomics example. Deep domain expertise. We have 2 PhDs in the multiomics space that understand, all of the discovery that AI is enabling in the healthcare space. And so deep domain expertise, AI expertise. The companies themselves have to take AI seriously and understand where their competitive advantages are. Typically, good distribution, but most important then is proprietary data that nobody else has. So proprietary data is one of our, what is going to be one of the defining characteristics of the success stories. In our portfolios, Tesla is the largest AI project on Earth. It has more real-world miles of driving data than all of the other technology companies and auto companies in the world, we believe. That is critically important, because this is going to be a winner-take-most world. The company able to get a person from point A to point B, the safest and the fastest is going to win. And we think Tesla is that company here, and we've been surprised recently that China has invited it to participate in that competition there. We didn't expect that to happen. So again, we're looking for companies that are going to harness the tools that, we're hearing about, the GPUs, the cloud, and everything, harness them to create new businesses that are going to transform our world. Transportation will be transformed. Healthcare absolutely will be transformed from treating symptoms into creating cures. We know that the commerce experience is going to be transformed. We know Shopify here, one of your own, and I must compliment Canada for having grown so much AI talent. I know Waterloo is, the university there is a hotbed for AI talent. And so much so that companies in the US are creating divisions, locating divisions here in Canada because of the AI talent and deep, deep expertise. So I think every sector will be transformed: transportation, healthcare, the whole commerce, retail experience, Shopify, harnessing AI tools. I don't think anything will be untouched. Even, you think about Warren Buffett. Yeah, one of his favorite sectors or industries is the rail industry. And the rail industry has been, since, for 100 plus years, a very good investment over time. But autonomous truck platoons or autonomous truck technology, we believe, if our research is correct, is going to lower the cost per ton mile of transportation from, in the human-driven trucking world, from something like 7 to 8 cents to 3 cents. Rail is at 4 cents now. So when we look at that, we say, wait a minute, think about how secure everybody feels around railroad technology right now. Those are not stranded assets. Those are performing assets. If autonomous trucking does what we think it's going to do, the rail in the U.S. as it is now, those assets could become stranded assets. Hopefully, we turn them around into high-speed rail. That would be nice. That would be nice because they have the rights of way. But doing what they're doing right now, we think there's a better solution brewing.
So, Kathy, as you've outlined some of the adjacent industries to AI, beyond AI, and what some of those opportunities may be into the future, has the speed of development changed your forecast, your outlook, as we continue to see advancements here and now? Has the speed of these developments changed your outlook and forecast?
Yes. So as we were doing our research, I'm going to say 5 years ago, we thought that the 5 major platforms around which we've centered our research would scale to $75 trillion in the next 5 to 10 years. That number has gone to $220 trillion. And right now, innovation in the equity markets, both public and private, is valued somewhere in the $15 to $20 trillion range. If we're right, in the next 5 to 10 years, that is going to go up tenfold. And what has been the biggest accelerant has been artificial intelligence. To give you a sense of this, when we were doing our work on how quickly AI training costs are falling, our original research, and inference costs too, our original research was they're dropping in the 50 to 60% range per year. Now that's fast, but as we've seen more and more breakthroughs, so deep learning was a breakthrough in 2012, transformer architecture was a huge breakthrough in 2017. As we've done more and more work on those, we're now learning that artificial training costs are dropping 75% per year, and AI inference costs are dropping 85 to 90% per year. Now, I will tell you that since last year since Big Ideas 2023 to Big Ideas 2024, so that's our big report every January, and it's on ark-invest.com, that number has been pretty stable, around 220 trillion. So we think we're reaching nothing steady state in innovation, but we've had some magnificent breakthroughs, and these breakthroughs take place in step functions. And so I think we can say with confidence that we're looking for a tenfold increase in the market cap of companies associated with innovation during the next 5 to 10 years. And many people say, tenfold increase, that's crazy. That doesn't make any sense. That doesn't happen. The poster child has been Tesla, and we were early there on that. And that was just EVs. EVs was our starting point. Now we've got autonomous travel. That is a whole new, a whole new story, a new chapter for Tesla. So what I love about innovation is innovation platforms. They are launching pads for more innovation. And so we think that 220 trillion will continue to increase. What's interesting, it's a little more than 10 to 15% of the market today. We think it will be 60% of the market in 2030. So, the broad-based benchmarks will have as these trends surface and really evolve quickly, they will incorporate the broad-based benchmarks innovation. Right now, however, when I say we have only 5% overlap, it's because they have not. Many of these companies have not met some of the standards for the S&P 500. Tesla, for example, didn't get in until I don't think it got in until it was a $500 billion market cap. How many companies are bigger than that, right? There aren't that many. So this is going to happen very quickly. So we think there's a lot of alpha generation, and what we're doing right now, great complement to broad-based benchmarks. And then we'll hand our companies off to the benchmarks as we're on to the next.
Well, maybe looking at here and now, as we see first rate cuts here in Canada, potentially rate cuts on the horizon in the US, what does that do from your perspective for innovation investing?
So I'm going to take you down a journey that we experienced around COVID to give you this answer. So in the early days of COVID, remember in March of 2000, it was around March 9th for us. I don't know, was it March 9th here too, around that time? Maybe you were onto this earlier than we are. I don't know. But we were in the oh no moment. The global economy is going to shut down. We're going into a depression. How many companies are going to fail? This is terrible. And I remember this was a 1 month period. 1 month. The markets, depending on which broad-based index you're using, went down 25 to 30% in 1 month. Our strategy, our flagship, went down 46%, and our ARKG, which is the earliest thematic play, therefore doesn't have the cash cushions or as much free cash flow, it went down, if I'm not mistaken, it went down more than 60% in 1 month. Okay. During that time, I was saying, wait a minute, who do you think is going to solve this problem? Who is going to sequence that coronavirus? Who is going to use synthetic biology to create tests so that we can figure out if we have this thing called COVID? Who is going to create the vaccine? Our companies are going to do that. Why are they down 60% plus? And the answer was they shouldn't have been. And we had this massive run with ARKG, the biggest beneficiary. Over an 11-month period, the flagship strategy, and this is so unique in history, this will never happen again. We don't want it to happen. But we were up 360% in 11 months. That's crazy, right? And even at the end of that, I was saying, keep some powder dry. Okay, why am I telling you that story? I'm telling you that story because I think especially 21 and 22, 23 was a great year for us. Lumpy, but great. But 21 and 22 were the same, like there was an extended version of that 1 month period as we were going into COVID, an extended period. And interest rates were going up. And, I think it's thrown a lot of businesses, we're seeing the fallout now. And our strategy was hurt the most of any strategy out there. And last year, with of interest rates coming down, great year for us. This year, those six interest rate cuts taken off the table, and it's been a tough year for us. Now we're moving in the other direction, interest rates being put back on the table. So I think that whole COVID, that 1 month and 11-month period, were a microcosm of what we're going through now. That 2-year period was the equivalent of that 1 month. I think last year was the beginning of a bull market favoring innovation. There's tiptoeing into it. That's why we have the Mag 6. The more those valuations are stretched, the more they have to look at us, because our valuations have never been at this low a premium relative to the broad-based benchmarks. So I think that 11-month period, we don't want anything like as much of that as soon. We'd like that to be stretched out over 5 years, but I think that's what's going to happen.
Coming back to the mandate you have for the 3 BMO ETFs here in Canada, how should our viewers, how should folks here in our audience think about utilizing in their portfolio construction?
So I think that many advisors have created well-diversified portfolios for their clients. And we've done a study. If you include our kind of innovation, disruptive innovation, not sustained innovation, as a slice of your equity allocation, we did a study, 5, 10, 15%. What you will find over time is that by adding our strategy, an advisor will increase returns per unit of risk over a 5-year period. The other very important thing to note about our strategies is that they are volatile. And so a rebalancing strategy is also important to accompany this. So we've also done a study showing that if you rebalance, let's say you incorporate 5%, include innovation, our innovation, 5%. At times it will get to 7.5% of the portfolio when there are breakthroughs or when macros like interest rates come down. So 7.5% rebalance down to 5%. Sometimes it will go to 2.5%, rebalance up to 5%. That's very broad-based, very long-term, and all of that. That strategy really pays off. That strategy really pays off. So it would be include some of it. If the correlation of our returns relative to the broad-based benchmarks is surprisingly low, you can see from the action this year. The broad-based benchmarks supercharged by 6 stocks, and we're lagging as the equal weight S&P, the equal weight anything is lagging. But that will change. That will change. And so incorporating our strategies as a percent and then rebalancing with time, but maintaining a position in truly disruptive innovation for the reason I just described, the tenfold plus increase that we are expecting from disruptive innovation market caps generally.
So, Kathy, maybe just to follow on and really in all simplest terms, folks should think about it as that growth complement to their portfolio?
Definitely growth, no question. But even within, so many strategies have, a growth benchmark, a value benchmark, an EM, an emerging market benchmark. We could take a piece of both the growth and the value, and I'll give you the paper we just wrote, which came out today, I think. And we're writing another one. We have another one written for next week, more macro. This one is just more strategy oriented. But I'm feeling today, having had the experience of the tech and telecom bubble and the tech and telecom bust, I feel like our portfolio is both at the same time. It feels like value strategies in the late 90s. And I remember I was at Alliance Capital. They bought This was a growth firm. It bought Sanford C. Bernstein, a value firm, because everybody thought value was dead and would never come back. And think about that. What a brilliant strategy that was. I feel like we're in that mode right now. So I think reversion to the mean, everybody learn, don't sell your value stocks just because they're underperforming. When those other stocks come down, that's going to be your salvation. But I also feel like we're where Amazon was in 2003. And Amazon was not making money, is still investing aggressively to become the online retail leader, certainly in the US, North America. And nobody wanted it. It was a $5 billion market cap. Now I think it's $2 trillion. $5 billion market cap. We bought it. And I remember at the time we were the only one, a strategy within AllianceBernstein buying it. And everybody was saying, that's ridiculous. That's ridiculous. The internet will never make anyone any money. That was a figment of Wall Street's imagination. I feel like we're there too, with our strategies. Now, how can you be in both at once? Well, you know what? I'm going to take that risk.
And maybe, Kevin, coming back to you, because and apologies, I've been only one direction for a little while, but when you get to sit next to Kathy, it's not every day. But Kevin, your thoughts, building on Harry's position here as they have the mandate on those BMO ETFs, your thoughts additionally how individuals here in Canada should think about utilizing these three products, how they should think about incorporating in their portfolio construction.
Absolutely. I think Kathy touched on the beginning. One of the things we've been advocates of is active and passive investing, bringing the two together. And, I look at ARK, the BMO ARK Innovation Fund, as being one of those good examples of mixing active and passive together. In fact, we have 3 mandates with Kathy, and what was great to hear today as I wrote with Kathy all day is that how artificial intelligence and the innovation coming through artificial intelligence are not just touching just the general theme of innovation, of course, but next generation internet, of course, and on top of that, genomics. You really start to hear the transformation you want in industry. So we are been very big advocates of mixing that. I like the idea of rebalancing our base and a portion of portfolio dedicated towards innovation. It makes sense to take a look at that mandate and say, somebody's portfolio.
Makes a ton of sense. I know we're coming up on time. We definitely want to get to a few questions here from the audience, but what would you say, Kevin, final thoughts as you're speaking to advisors that are joining us over the web and here in the room, final thoughts as they consider these products and for their clients, what message would you have for them?
And actually, first of all, take a look at the products, take a look at the holdings and the transparency of the products out there. That's been a nice big benefit. So take a look at how they offer kind of a value add of bringing these kind of solutions together. And passive on those. On top of that, actually, I think the 3 of us represent pretty good history coming together to offer, advisors another way of investing in the marketplace and capturing innovation. ARK, BMO, and now Cboe together.
Kathy, last word.
Innovation.
All right. With that, we have time just for a few questions from the audience. So maybe if there's a few questions here, love to field them.
Hi. Yeah, I have a question for Kathy regarding the Optimus robot. So, I noticed in your 2029 outlook, you didn't include the humanoid robots, but I think Musk had at one point said that they will no longer be a car company. They will essentially be a robot company. Are you likely to include that in the near future?
So Tesla is a robot company because autonomous vehicles first are robots. So he's our work. So if you look at Big Ideas 2024, you'll see that we believe the humanoid or the robotics market is going to be a $25 trillion market in the next 5 to 10 years. So right now in the industrial world, there are only 700,000 industrial robots in the world. Why? Because they're too dangerous. They're locked up in cages, mostly in auto manufacturing plants, right? So we think that's changing with sensors. The sensors, and And Tesla, even on its cars, has sensors. They're called cameras, right? But all kinds of sensors on robots. So 25 trillion, half industrial, half more personal. 8 billion people in the world. He thinks we'll have 2 or 3 robots per person on average, some of them at home, some of them at work. So I think you meant our Tesla model did not include humanoid robots. And you're absolutely right. We're doing a lot of work on it right now. Our model didn't need to include robots, given how much we see the autonomous taxi network opportunity evolving, and we wanted to communicate, look, we're including very little for energy storage or humanoid robots. Those are 2 very big ideas, very big ideas. I think Tesla now has 2 humanoid robots, maybe more by now, roaming around. I think it's planned in Austin. I saw Figure AI's humanoid robot make coffee and do so very well. I'm looking forward to having a robot make me coffee every morning. So we think the convergence, this is the convergence. Tesla's all about this convergence of robots, energy storage, so it's all battery technology, and artificial intelligence. It's the same. The humanoid robot is the same as the autonomous vehicle, but it'll have fewer parts. It'll be simpler. It'll be much easier to scale. That's why, as we're doing our work on it right now, and thinking about the scaling, as soon as the robotaxi or the autonomous taxi network is launched, we'll probably be inserting the humanoid robot, because that's the next big leg of the story. Yeah, it's exciting.
You're terrified to get in that taxi, but all right.
No, you shouldn't be. You know why?
I'd love to learn.
Yeah. 85% of all accidents are caused by human error. In a rules-based ecosystem, machines will do better than human beings. That, even when we started doing our research, it took a while for us to say, wait a minute, what this artificial intelligence is all about is there are things that machines are going to do much better than human beings. And we learned a lot from AlphaGo. The champion of AlphaGo, a South Korean man, thought he was a shoo-in against the machine. Well, guess what? The machine won. He was just heartbroken. But what is he doing now? He's only training with the machine. Now he's getting even better than most human beings because he's competing against the machine. So this is going to eliminate, we think, 75 to 85% of the accidents. And I think the reason regulators are more friendly to this now, if you listen to Pete Buttigieg, you'll hear he's friendly. He's thinking, yeah, this is all going autonomous. I was shocked to hear this. That's because he is responsible for the fact that human deaths, fatalities on U.S. roads have increased from roughly 30,000 about 10 years ago to nearly 45,000 after decades of going down. What has happened? Texting, distractions, right? And disproportionately, young people are dying. And so the regulators are saying, oh my gosh, this is on our watch. So they've become very data-driven. And Tesla's car, we've done their research. We're practically advertising for Tesla on ramps. If you look at the average car on the road in the United States, it has an accident once every 200,000 miles. The average Tesla with FSD, full self-driving, and this is old FSD, 6 to 9 months ago, has an accident every 3.2 million miles. 200,000, 3.2 million miles. 16 times safer. Volvo built his brand on safety. Tesla's not even selling itself that way, but we are. Wait.
Kathy, I know we're asking the audience, but we have just one follow-on.
Oh, yes, sorry. It's a
No, I'm coming with the question now. So on that thought, and just to bring that closure, given the safety record and what the potential implications are really drastically changes are with AI, with autonomous vehicles, what does that do to insurance?
It's interesting. Right now, the insurance industry charges people with Teslas and even with FSD more than they do other parts. Why? Because repairs are tougher. Then the ecosystem is not in place yet, and Elon knows that and is addressing it. Elon is willing to self-insure. Elon is discontinuous as the repair network is built out. Tesla will insure itself, and it'll have captive insurance because the range should go down as matters.
Time for one last question from the audience. Kathy, for the free ETFs, the securities of these are one you buy today. If I think I'm going on ARK token, I've got $1 million. The people to be this ETF with this all free.
Well, it depends on your risk profile. So the other funds with the most disadvantaged by the environment in it is ARAG because it's the earliest. You don't have big cash cushions. A lot of the companies are not free cash flow yet. They're investing still. And so that is the most disadvantaged. And I think that will be the biggest rebound in a market where interest rates are falling, risk appetites increase, and time horizons move out. If you're not, if your risk profile is a little less than that, then ARK can, because about a quarter of it is ARKG. And so you've got a little bit of a buffer, although it won't be as volatile. And then ARKW has done the best because it is much more pure AI, cloud, and digital assets focused in the next generation of internet. So if you wanted a differentiated play there that doesn't look like broad-based indexes, that is a good diversifier. So CFS will for you.
With that, I know we're over time. You've been a fantastic audience. Thank you so much.